Hello, this is AK Asthani from Smart VRC Bhopal. Topic is risk है तो इश्क है. I don't think it needs more of introduction. So in stock market there are stocks which gain and which gain tremendously. So we can represent the stocks into two categories of a coin. One is the head and that is Ishk. When I say Ishk, Ishk means stocks like Infosys, Shree Cement, HDFC Bank and Kotak Mahindra Bank, which have gained tremendously during last so many years. And on the other side, there is the tail, that is the other side of the coin. There are stocks like Arcom, IL&FS Transportation, Suzlon, Kohinoor Foods and so many stocks. These stocks have lost price tremendously during last couple of years. So इश्क है तो risk है. In stock market, on one side there are stocks which have gained tremendously and on the other side there are stocks which have lost significantly. Let's have a look what has happened during last 2 years. Yes, in a matter of just 2 years, what kind of returns stocks have gained and what kind of losses investors have suffered during these last 2 years. So these are the Ishk stocks, and this is not the exhaustive list. This is I have randomly selected. There are stocks like Aarti Drugs which have gained 371%, GMM Fowler 369%, and so many stocks are there. Granules, Bajaj Finance, Infosys, Reliance, TCS, Kotak Mahindra, HDFC Bank and Shree Cement. By any means, these gains are tremendous. 2 years and 370% or 200% returns or even 100% returns is phenomenal. And on the other hand, there are stocks like IL&FS Transportation, PC Jewelers, Yes Bank, Arcom, DHFL, Kohinoor Foods, Unidex, Suzlon, which have lost as much as 98%. Yes, had you invested 1 lakh rupees, you are left with only 2,000 rupees. You have lost 98,000 rupees. And there are many investors, millions of investors who have suffered such kind of losses. So there are two parts. One is the ishq, other is the risk, and you have to invest very cautiously, very judiciously. And during the same period, BSE Sensex returns are 33%. Now you will appreciate that there are stocks which have gained 10 times more than BSE Sensex during this period, and also there are stocks which have lost heavily against the Sensex gains of 33%. One more thing I would like to highlight here, and that is this is a performance for last 2 years. Now see what has happened. Reliance Industries has a very heavy weight in Sensex. It is a part of Sensex and a very heavy weight. Similarly, TCS has a significantly higher allocation in Sensex. HDFC Bank also, Infosys also, and all these stocks have gained much more than the BSE Sensex. So what the point I want to highlight is, it is the limited stocks from the BSE Sensex which have gained tremendously, significantly, and because of that the Sensex has gained. Not all across the stock market, not all stocks have gained so much. As you can see from the Sensex numbers, even 33% rise is not an average rise. It is a Sensex rise. Now, how to outperform the BSE Sensex? For that, you have to look for only the positive stories, and you have to be very cautious in picking the stocks, and you have to remain very cautious while holding the stocks, so that anytime if you see that the story is deteriorating or the performance is going bad or slowing down, then you have to make an exit, rather timely exit, so that your stock should not be counted on the risk part of the coin. Now this is a chart of Yes Bank, and presently its value is about 15 rupees. Just not even 2 years ago, its share price was booming like anything, and on 1st of January 2018, its share price was rupees 300 plus, and it was on 25th of January when we made an exit from Yes Bank stock from smart multi-baggers, and the reason was the first time when the RBI disclosed that the NPS being disclosed by the bank are less compared to the actual NPS, and that trigger was enough for us, and we made an exit. And after that, stock kept on moving up and down. It went up to very near to 400 also, and some of the investors, they contacted us and asked us that why they exited this stock, but we were very much convinced with the exit strategy, and that proved right in the subsequent months, as you can see. So the point here is, it is not that you can only have the positive stocks in your portfolio. The time comes when the story starts turning bad, and that is the time when the stock shifts from Ishk category to risk category, and that is the time for us to make an exit. That is the crux of the story. Yes, risk hai to ishq hai, and it is a balance, but higher the risk, higher the returns. It is up to you how you select the stocks. So first of all, you have to decide how much risk you can tolerate, how much is your capacity to bear the risk, and then only look for the maximum returns in that category of risk. So that way, that ishq will be always in your favor compared to risk. For the given risk, you have to look for the maximum returns. Okay. So I am very sure those of who are investing for more than 1 year, yes, I am talking about only 1 year because there are lots of ups and downs during last 1 year, you will appreciate that you have to keep dancing with greed and fear. Okay. So you have to regulate your emotions with greed and fear prevalent in the market. So this is the performance about smart billionaire picks, wherein we started with rupees 1 lakh on 30th of May 2001, and today its value is 24 lakhs after 19.5 years. Yes, from 1 lakh to 84 lakhs in 19.5 years, and that gives a CAGR of 25.46%. It is a very high CAGR considering also the duration of 19.5 years. If this SBP continues to grow at this rate, then it will reach 100 crores. Yes, 1 billion, from 1 lakh to 100 crores in about 40 years. And that is the performance of SBP. As I said, smart billionaire picks, there is a part of smart gains, our most popular product. This is the performance of smart billionaire picks compared to BSE sensitive index, and as you can see, we have done exceedingly well. We have been able to increase the gap between SBP and BSE Sensex, rather I should say any broad-based index, and we have never asked investors to put in money in between. Neither we have made an exit, in a sense, neither we have booked profit in terms of cash. Whenever we have sold any stock, we have purchased another stock of same amount. So we have been fully invested for this long duration of 19.5 years. We have seen many bulls and bear phases and always remain invested 100%. So how we perform since 23rd March 2020, that was the bottom formation for the recent, I can say, bull phase, because market is up by about 60 to 70% from those levels. So on that day, the BSE sensitive index was 25,981, while smart billionaire picks was 41.63 lakhs. So this is an index, while smart billionaire picks is in rupees lakhs. So on 4th of December 2020, the BSE sensitive index has increased to 45,079 points, while smart billionaire picks has more than doubled to 83.98 lakhs. So in terms of percentage, BSE sensitive index is up by 73.5%, while during the same period, smart billionaire picks is up by 101.72%. And as I said, there are handful of stocks among the BSE sensitive index which have made the BSE sensitive index to gain by 73%, while we have 18 to 20 stocks at a time in smart billionaire picks, and more than half of them contribute significantly to this gain of 101%. So ours is a broad-based performance. It is how you pick the stock, and you will be surprised to know that we don't have those 4-5 stocks which are available in the BSE Sensex, and despite that we have been able to outperform the broad-based indices by so much of margin. So the smart word is risk should not be considered as the volatility. Rather, I should say the other way. Volatility does not mean risk. If the Sensex is moving up and down by big margins, that does not mean the market is risky. Risk is not knowing what you are buying. Risk lies in the stocks which you own, the underlying companies, what they are doing, what are their future prospects, what is their debt position, how much shares are pledged by the promoters for what purpose, and many things. So understand what stocks you are buying, what those underlying companies are doing, what are their future plans, how they are going to increase their sales, or how they are going to increase their profit margins. That is how we need to control the risk. It is a calculated risk. After this presentation, we shall have a question answer session, and in question answer session, those who have any queries, they can raise their hand in the chat box, and I will ask them one by one to unmute themselves and raise the query. Thank you.